Everyone, welcome back to my channel. So in today's video, I'm going to do a deep dive into interest rates. So you guys have already heard of me talking or mentioning about interest rates in my previous video. If you haven't watched it, click above. We talk about student loans and how interest rates affected my student loan repayment decision. So feel free to click above to watch the video. But in today's video, I wanted to talk specifically about interest rates. In my opinion, it's too important not to talk about it. As you took economics majors or studied macro or microeconomics in university, you don't really hear about it anywhere else in school. I mean, we don't have a course called personal finance in high school. So if you've heard of the term interest rates being thrown loosely by others, and if you've read any kind of newsletters that talk about interest rates, sometimes we forget how big of an impact that interest rates can have in our personal lives. And we're gonna start off the video by talking about The Merchants of Venice by William Shakespeare. So as you all know, that story begins with somebody who defaults on his loans because he couldn't pay back his loan, right? So the concept of borrowing money and lending money is not new, and it's just kind of evolved over the past couple hundred years, and that's the reason why I want to incorporate some of those stories in today's video to let you know how interest rates kind of evolved. So if you want to hear more about it, then stick around and keep on watching.
Okay, so everyone knows about Shylock, right? Even those who are not familiar with Shakespeare or about the story of Merchants of Venice, everybody knows about that vicious moneylender who lends money to Antonio to give to his friend. However, Antonio could never pay back his loan due to outrageous interest rate, therefore he must give Shylock a pound of his flesh. The concept of interest rates is not something new. It's been around for thousands of years since the dawn of civilization. In fact, there are some historical records that can be traced back all the way back to 3000 BC. So I'm going to talk about what exactly is an interest rate. It is a form of fee charged to borrow money. So think about when you want to buy a car, when you want to buy a new house, what do? A lot of the time, most of us don't have the cash to go in and buy the car or the house. So what we have to do is we have to borrow money, right? So it is a form of fee that we are being charged to borrow money from either other financial institutions or other lenders, right? So that's what an interest is. Interest rate is a specific percentage of the amount of money borrowed that needs to be paid back. So in order for me to go ahead and borrow money from my bank, I have to pay back interest rate at a certain percentage. Say, for example, maybe it's 6.5% if I take out a loan in my line of credit, or as you all know, when you use credit cards and if you don't pay them back in full amount that you used in your previous months, then you could also be charged for interest rate, right? And a lot of the times, credit card interest rate is notoriously high, anywhere between 18 to 20 something percent. So Bank of Canada determines interest rates by examining various economic factors, such as unemployment rate, our GDP growth, and trade tension. As everybody's aware, there's a trade war going on between US and China, also foreign exchange rates, inflation rate, etc. So the Bank of Canada essentially helps the Canadian government to manage the economy by setting the bank rate and controlling the money supply. So how does it do that? So basically the bank carries out its monetary policy by influencing short-term interest rates. And it does this by raising and lowering the target for the overnight rate, right? So this is a key. Bank of Canada is in charge of raising and lowering the overnight rate. An interest at which major financial institutions borrow and lend in one day. So that's the target overnight rate at which other commercial and local banks can go and borrow that money, right? It's not necessarily what we are being charged for different types of services where we borrow money, but this is a key when overnight rate set by a central bank goes up, then our actual prime rate that we're being charged for borrowing money will also go up. So they tend to go up and down, like they are in sync with one another. If Bank of Canada actually increase the interest rate, then you'll soon discover that all the banks will therefore increase their primary interest rate as well. Okay. And in the United States, they have what's called the Federal Reserve System. So this is the central bank which determines interest rate. So similarly, just like Bank of Canada, in the US, it's called the Federal Reserve for short. And what they do is essentially the same thing. They control the interest rate and they determine the interest rate by looking at various factors. So let's look at the historical graph of this interest rate in Canada specifically, right? So it's not always low, right? Like we can see that as of recently, the past couple of years, it's been really low actually, targeting 2% and 1% around. We've been hovering over here, but as you can see, if you go like even all the way back to early 2000s and 2007, look at this, boom, like high interest rate, right? So interest rates do fluctuate, and as a result of the financial crisis, you can see there's a huge dip in interest rate, right? Because after the financial crisis, basically the economy was in recession, right? Where the financial market collapsed overnight, and therefore the banks had to make drastic changes in order to stimulate the economy. So they've um, they've been keeping it low and they've been very cautious. So as you can see, we haven't seen that many interest rate hikes since the financial crisis in 2009. However, global markets in 2018 have been rosy and it's been supported by strong economic growth and numbers, right? And higher employment and excellent corporate profits. So all of this sort of led to the stimulation of interest rates, right, on the rise, and which is what happened, right? Essentially, the central bank, the Bank of Canada, as well as the Federal Reserve, decided to increase interest rates. It wasn't a lot. It's still relatively low if we look at the history of interest rates. So I just wanted to show you the historical graphs of interest rates in Canada as well as in the United States. So you can see that they're very closely aligned. And what's really interesting is that if US lowers interest rates while Canada doesn't, then what's going to happen is it's going to actually appreciate our Canadian currency. So a lot of you might be thinking, well, isn't that a good thing that your currency is getting stronger? Not necessarily. So in Canada, we are an export-driven economy, which means we want to sell as much things as we can in order to stimulate our GDP growth. And by having stronger currency, this can have devastating effects as we don't want our currency to get too strong, which will drive down the demand for our goods and services, right? So it is very interesting that interest rates can have such an impact on our economy, not just because it controls the money supply and demand, but also because it can have a huge impact on our foreign currency as well, right? I find it very fascinating. Okay, so a lot of you might be thinking like, why does it matter? Why does it matter? Why do I care? I've never cared a thing about interest rate my whole life. Why should I start caring now? Right? So, I mean, I think this graph is a very good summary of a lot of the world events that have happened over the past 171 years, right? So as you can see, interest rates play a huge role whenever there is a recession or economic crisis, or when things are going really well, right? So it does play a significant part in stimulating our economy because it basically controls demand and supply for money, right? So higher interest rates means lower demand for borrowed money because people don't want to and cannot afford to borrow money at a higher interest rate, right? Would you want to buy a car if you need to pay 20, 14, 15, or even 20% in interest rates? A lot of people say, no, forget about it, right? I would rather take a bus or SkyTrain than to pay 20% just in interest rate, not even the principal amount that you borrowed, right? So higher interest rates directly impact our financial market as well. This is exactly why when Federal Reserve announced that it'll consider lowering interest rate recently, the market rebounded, which was the second biggest daily gain of 2019. So as you can see, S&P 500 as well as Nasdaq. Do you see the sharp increase? This is a trader's relief after hearing, uh, Powell talking about possibly cutting interest rates. So you can see that it does have a huge impact on our financial market, right? So think about what kind of impact it's going to have on your pension plan or RSP or 401k, right? So it does impact us. Um, and it literally impacts and I cannot stress this enough. It literally impacts every aspect of our lives, as you can see from, you know, from this list, right? Mortgage interest rate, credit card interest rates, student loans, car payments, line of credits, bond prices, your TFSA or savings account, your pension plan, RSP, your stock investments, any kind of a consumer spending. Like nobody wants to spend money if they have to pay more in interest rate than the money that they borrowed, right? So people tend to slow down their consumer spending in when there's high interest rate. Also small business loans, right? So your local economy is also going to be impacted as well. So it literally impacts every aspect of our lives, as you can see from this list, and your future money as well. Like I mentioned before, your pension plan, your 401k, your RSP. Think about your future investments. So, of course, it matters that you understand the impact of what it means when there's a rate increase or decrease. Sometimes you need to rebalance your portfolio in order to mitigate losses or potential risk. So I'm gonna actually do a follow-up video on this topic about how to mitigate risks and what kind of things that I've done in the past when there were some bullish actions in the market. It is also one of the biggest economic factors that can drive growth in the economy when the rate is low in order to encourage people to spend more money. This is also the reason why Mr. Trump is really, really strongly pushing and advising the Fed to cut the rates. Think about upcoming presidential election in 2020. Of course he would want to show a track record of a growing economy, right? So this is why he's been really pushing Fed to cut rates. So last but not least, I just wanted to kind of quickly touch base on the current news of where interest rates are at, right? So as of mid-July, there's still U.S. trade wars, especially with China and Mexico, right? There's a trade wars going on, and as well falling long-term interest rates, right? The falling price of commodity and oil, and some signs of general economic slowdown, which is, which are big concerns. As a result, the broad market had been in decline for the past 4 weeks. What's interesting is that these concerns suddenly reversed on Tuesday when Jerome Powell, as I mentioned, chair of the US Federal Reserve, stated that they were monitoring recent trade developments and would act, quote unquote, act as appropriate to sustain the economic expansion. And similarly, laws from Bank of Canada flagged elevated concerns about mounting global trade tensions, as I mentioned before, and then they decided to leave interest rates unchanged for a sixth straight decision and showed little willingness to consider easing policy anytime soon. So as of yesterday, on Wednesday, July the 11th, they kept the current policy rate at 1.75%, and then they painted a picture of potentially improving Canadian economy, but we don't know yet. We're not so sure. It sort of depends on how things go between US and China, and also in China and Canada, due to Huawei executive who's being detained in Vancouver, Canada. So there's a lot of things going on, and it seems like to me that a lot of politics are spilling into our economic policy, and I can definitely see that there's growing concerns about the global economy as trade tensions go up. But as I mentioned before, it is a job of central banks to monitor these economic factors, to take those things into consideration, and then to forecast what the future economy is going to look like. And they're going to take, once they take all those things into consideration, they're going to determine what's appropriate to keep as an overnight rate. So that's it for today's video. I hope you found it useful. Let me know what you think. I wanted to try something different, and if there's anything else that you'd like to see in future videos as well. And I'll talk to you guys later. Bye.